It's a bit like, why did Jesse James rob banks? Because that's where the money was. Why do we have asset price inflation? Because we have banks, because that's where the money is. Hugh Hendry, I'm the asset capitalist. I'm in San Francisco. I'm here. We've got a student of the one and only Richard Werner. What he doesn't know about the world of banks, you don't need to know. And here we are. I've come to San Francisco. Out there was a bank in Silicon Valley, very close, and that bank doesn't exist today. And Josh, you've just said, hey, asset capitalist, hey, Professor Werner, what's going on? Because we've now seen the demise of two banks in the US. We've seen the demise of one of the largest banks in Europe, which has been going on for 169 years. That's way longer than Bear Stearns and Lehman Brothers. This weekend, there are great fears concerning Deutsche Bank, probably misplaced. Josh, to your point, I think the principal US equity markets are almost flat on the month, possibly up on the year. If we look at the credit instruments, that if we have a register of the inflammation of risk, if we look at European IOS spreads, says nothing. If we look at European financial spreads, the CDS pricing, and we put it in its historical context, kind of says no great drama. If we look at its Japanese compatriot index, senior financial spreads, again, it says no great drama. Your point is, what is happening? And indeed, why am I professing still a continued great fear about equities? Surely I've been called out. Here we've had a run on the universal banking system, and equities have just shrugged their shoulders. Atlas has shrugged. So 2 quick points to that. The road to salvation is long and torturous. I had to survive with my cookie ideas from April 2007 to the ultimate demise of the financial sector in September, October of 2008. And believe me, there were profound rallies. I mean, after the demise of Bear Stearns, 3 months in the future, the European Central Bank thought the future was just so inflationary, they had to raise interest rates. So we know that whatever happens next does not necessarily have to be rational. We live in an irrational world, people. Richard, tell me, what do I need to know? Right.
What I want to know, and I think that'll tell us a lot.
Why is the financial system not concerned about what we've seen? The plumbing, the pricing of senior financials, etc.
Yes. Well, I think people are wondering and I think we have different views out there, and clearly people are wondering about one issue, and that is, what has the Fed been doing? I mean, my question is, why on earth did the Silicon Valley Bank, why was it shut down? Because it was, as far as we know, a solvent bank. Then a run on deposits was staged. There was a bunch of Silicon Valley large investors moving out and telling everyone else to pull their money out. Well, you know why the Federal Reserve was created? Congress 5 years ago was quite reluctant to actually have the Federal Reserve created, and the argument was made that, well, what happens if you have a strong bank, even the strongest bank, but there's a run on its deposits? Even the strongest bank can't do anything if you have that. That's when we have the Federal Reserve. They can step in and they can just lend short-term liquidity, and then there's no problem, because that is a weakness of all banking systems, that if somehow, for some irrational or rational reasons, depositors pull out money from the strongest and most solvent bank, you'll still get a problem. So where was the Fed? Why did the Fed let this bank go under and the regulators closed it down? It would have been the Fed's job on that Thursday, when so much money, almost 40 billion, were pulled out in deposits, to just supply that from the Fed, San Francisco Fed maybe, and then those who pull out realize, okay, nothing happens. And the short sellers, of course, also realize nothing happens. And then you get this you don't get the self-fulfilling prophecy. Of course, you've got short sellers, they're making a lot of money on going short on these bank stocks.
Richard,
but instead they closed 3 banks. So what is the story with the Fed?
That's a great,
this is what investors, I think, are wondering.
No. Okay, that's a great reveal. Okay, so we'll try and spar on this. Okay, I don't think the Federal Reserve was at fault. I think the Federal Reserve actually did a great deal in terms of. I mean, I would fault the Federal Reserve and to the degree of leniency that it showed. So what I want to say is, as you know, the central banks have created a very favorable system for the banks to take risk in terms they want banks to concentrate their risk in lending to the government, okay? And they've said you can lend to the government via holding US Treasury, and indeed in Europe we begin to the sovereign paper, and we will not mark you to market, okay? And so Silicon Valley was the invisible gorilla. It was quoted on the stock market. It was quoted every single day. It reported its quarterly data, and the quarterly data revealed that it had an unmarked loss on its securities, treasury securities, which was greater than its shareholder funds, which is a very unstable equilibrium. And what we didn't know at that point was we didn't realize we'd moved into the smartphone era of bank runs, where it's not 5% of the money that can be pulled, because you've got to, if we remember August 2007 in Northern Rock, where we had lines, the British bank, where we had lines of depositors.
The lines were because the online system had shut down. So the problem was their mobile banking didn't shut down.
There you go. That was the Fed's reserve problem. The problem was they should have closed down.
Yes, but really, of course, that was basically therefore a misunderstanding. Because whenever interest rates rise, financial institutions, present value calculations mean that you have theoretical losses on all your assets, whatever they are. The best assets, of course, are treasuries. So really, there's nothing surprising there. And this could only be a problem if, for some strange reason, there would be a run on deposits. Surprise, surprise, that was triggered. So I was surprised that this chart, I mean, it was going around for almost 2 months preceding this graph with the aggregate. I think it's an FDIC data graph showing these paper losses in the banking system. It happens whenever interest rates go up. It's always been the same story. So and it's not a problem. Why did we artificially argue that this somehow is a problem? And of course, you don't mark to market in banking. That's why it's called banking. Loans are not marked to market. And if you hold bonds to maturity, and if the US government doesn't go bust, then you get your 100 back. So there was no problem if the Fed provides the short-term liquidity, and that was the weak point. Why didn't they do it?
That's an excellent point. Loans are not marked to market. Okay. But the curiosity in the examination of public markets is that they determine when those loans are actually, the real intrinsic value is below the mark, and then they come after you. Okay. So actually, I see the same thing. Okay. The second point is that I don't think it was a failure of the Federal Reserve. I think what speaks more widely is that there was a private sector solution to the bank, which is you take, and banks do this, banks do this all of the time. You have short-term funding demands depending on what's happening to deposits. And you can aggregate illiquid loans. These are assets. You can aggregate them and you can offer them as collateral, and you can offer them at the broker-dealer window, and in return, with a haircut, with a reasonable haircut, a JP Morgan of this world will borrow or lend you their treasuries. And with those treasuries, you then go to another window and you get the financing. But what had happened in the weeks leading up to the demise of Signature and SVB is that the brethren banks, the peer group, said, actually, what we're seeing this is my presumption, what we're seeing in the real economy, actually, we're all confronted with these financing issues because the economy is really, really coming under duress. So the haircut that I'm going to insist upon to take your illiquid loans is so great that you're going to refuse. And at that point, I'm pushing you back to the Federal Reserve. And potentially at that point, the Federal Reserve made an error.
Yes, but of course, it wasn't really the illiquid loans that were the problem. It was securities, including a big amount of treasuries, and there should never be a problem there. So they should not have been forced to sell them. So really, we know that they sold securities earlier at a loss. That should have been avoided already, because it's against the principle of banking. That you realize these losses just on the basis of some depositors pulling out. That's why we have the Fed. But of course, we shouldn't forget. So the Fed was founded on this idea, and that's how it was sold to the reluctant Congress to have the Fed, that when there's a run on good banks, solvent banks, the Fed will step in. What happened in the 1930s? The Fed did not step in. It let 10,000 banks go bust, and there was no deposit insurance either. So people literally lost all their money. People became destitute. There was literally starvation in the US. Just read John Steinbeck's The Grapes of Wrath. So that was the reality. The Fed has never lived up to their promise, and we have to wonder why. What is their agenda? Of course, some people have pointed out that Silicon Valley Bank, just like the Silvergate and Signature Bank, were the banks that were most engaged with the crypto world. And in fact, it seems that other banks were discouraged, and everyone was sent to these three banks. And now the Fed has let them go bust. So, of course, a lot of people are suggesting maybe this is part of this drive to get rid of this competition of cryptocurrencies. And maybe there's a connection to the introduction of the first stage of central bank digital currencies, because the central bank, this is, I think, what a lot of people are starting to realize, that a central bank is maybe not a disinterested umpire if it has already declared that it's looking into, as an umpire, stepping into the arena and competing with everyone else by preparing to offer their own current accounts at the central bank digital currency. So I think there could be a connection. And certainly a lot of people will be and have been wondering about this.
I don't subscribe much to that. To my mind, the locus of attention coming from those particular banks is that their principal clients, especially SVB, were mostly acutely exposed to the travails of the economy. They were startup companies who are under considerable cash pressure, which is typically alleviated via subsequent funding rounds. The funding rounds are over because we've created fictitious wealth via marks on previous funding rounds, which are not reflected in private equity books. They're not reflected in hedge fund books, and therefore not seeing any opportunity for the next funding round. It put the pressure on the bank to continue financing them. And as deposits were wound down with the bank, the wherewithal, when the discount window was closed by the Brethren banking group, just made it an impossible situation. Rich, you raised the point, the grapes of wrath. I want to return to that because my ongoing concern about risk assets for 2 years, if not longer, actually, I don't see it as an agenda. I see it as profound incompetence by well-meaning public servants, the Federal Reserve. And I want to say to you that the thing that fills me with horror has been the persistency by these regulators to attempt to tighten credit, to raise interest rates since 2013, when we had Bernanke and his taper tantrum, which was very much encouraging the private sector to lift rates, when we had adult unemployment still in excess of 7.5% in the continent of North America, followed by Janet Yellen actually raising rates modestly in 2015, followed by the real deal, Jay Powell, raising rates only for, again, the market to push back, and then he pulled back. But then he's come strong again, and he's raised rates dramatically. He's raised. The problem with, you can have a lot of leverage in an economy if you keep the carry minimal. If you take the carry to the levels that they've taken, you break the system. So my point to you is these persistent desires to tighten credit have created a depression, which for the average American is actually way more severe than Steinbeck's grapes of wrath. If you look at average per capita US GDP growth, and you from 2009 to present, and you correspond that to the similar period from 1930, and you fast forward 13, 14 years, the average American's GDP per capita was 80% greater than it was at the starting point, whereas this time around is less than 20% greater. And I lay that great crime on the Federal Reserve. We've lost the equivalent of Chinese GDP. $15 trillion of potential GDP has been eliminated or forgone by these fruitless exercises in raising interest rates. What do you say to that?
Well, I agree that economic growth, I mean, I put it slightly differently, but I agree that economic growth could be much higher. In fact, in many countries, and that lost potential output is a loss that's never going to, be recovered, and that is a shame. And that's true for many countries. In Europe, they've suppressed growth for so long, and now they've got all these artificial policies to completely smash the economy further. Whenever you think they can't do much worse, they come up with ideas to further hurt the economy. These are huge losses, and it's a waste. It's possible to have double-digit economic growth in real terms with low inflation and stability and without crises by making sure that bank credit creation goes to productive purposes for business investment, which is mainly the case when you have many small banks lending to small firms. That creates jobs and creates this non-inflationary, very stable and fairly equitable economic growth. That's, of course, what China did for 40 years. And that's what Germany and Japan did previously, and the US has been doing until its small banks get under pressure. That's why this, is slightly concerning what's going on, and I do see a bigger role for the Fed. They should certainly have prevented the situation. A lot of people seem to be moving money from small banks. In 2008 in Germany, people were pulling their money from the big banks and putting into the small local banks because they correctly realized that that's where it's safe. They don't do the speculative deals that blow up banks. It was the big banks doing that. So, but the development is in the wrong direction on that count. But it wouldn't be surprising if you have a central bank that wants to get rid of banks. I mean, the ECB is much more explicit about that. The ECB says on the record, there's too many banks here. The number of banks has to be reduced. Well, they've been doing a good job. They've killed 5,000 and counting, and there will be more forced mergers. And it would be very sad to see this happening in the US. I think people should speak up, and the Fed should be called to account. Its job is actually to nurture the banking system. It should encourage the creation of new banks. It should avoid mergers and the number of banks going down. Then it's doing a good job as regulator, I think. But maybe, Josh, any further question? Maybe just brief questions, and we'll just fire away with brief answers.
Brief questions. Okay. Yeah, just on that point then, interest rates, you sort of blame that GDP per capita drop by interest rates, no? Hugh?
I'm saying to you that we've had at least 3 episodes of the Federal Reserve trying to tighten money, that ever since the invention on US sovereign land of Richard's notion of quantitative easing, both private sector speculators and the Federal Reserve have convinced themselves that this form of bank reserve inflation actually creates the monetary phenomenon that we call inflation. And it's led them into what I would say a catastrophically wrong monetary policy, which has created a depression, which the conceit in the world of media, in the world of economists in the US Treasury, we saw it through the lens of COVID. We've grown to understand there are some terms which you're not permitted to use on platforms such as Twitter and financial publications. You're discouraged from referring to today's circumstances as an economic depression. Why? I'm saying to you, the evidence points to the fact that globally we're confronted with a depression which is of a magnitude greater than the 1930s with regard to average per capita GDP?
Well, I agree that particularly one section of society has suffered a lot, and that is really the sort of middle class and also the small and medium-sized enterprises. And they've been really hurt a lot in the last 3 years. And that is very concerning because that is the backbone of most economies. And really, if you want prosperity, you have to support them, not hurt them. So we do need policies addressing that. I agree with you.
Okay.
Hugh, so do you not think that when a bank extends a loan, when it extends a loan, that's not new money into the system, that's old money?
That is new money, Josh. That's new money. And the rate of new money creation via bank. So I don't look at
loans over 2022 increased by slightly over $1 trillion. And then you're sort of saying that there's money contraction.
I'm saying to you that $1 trillion expansion in bank loans is one over the denominator of, what do you think, Richard, of about 17-18 trillion dollars. So the incremental growth is actually less than what we would hope for nominal GDP growth. And therefore, does it move the mark? It does, but not hugely. And we're talking about 2022 versus 2021. And so that's against the backdrop of what is meant to be the hottest economy ever, where the nominal GDP is apparently off to the moon. So actually, contextually, the monetary creation through new credit creation, we're talking about maybe growth of 3.5%, 4%. Not a lot. It doesn't sound like 10, 15%. It's certainly not the rate of growth which is being manifest in the average price of goods and services versus the previous year. There's a disconnect. Tell me, the question for you from your introduction, you were saying that part of the solution that you would propose if you were running the damn system is that you would be purchasing good credits. You'd be purchasing assets from the non-banking sector. The central bank would be purchasing those assets. And today that would take the form of buying it from BlackRock et al. Yeah. Why is it a good thing? Why does the central bank need to own good assets on its balance sheet?
Well, it was a proposal, remember, for Japan when it was in big deflation, economic contraction, depression. And then you need to kickstart bank credit to expand the economy. So you've got this two-step policy. You clean up the bank balance sheets by the central bank purchasing non-performing assets from banks, but then you force new money creation into the economy and force banks to create new money by the central bank purchasing performing assets from non-banks. And it doesn't matter what, really. But that is a policy for that set of circumstances. It's not a policy they should have adopted in March 2020. Okay. Absolutely not. The circumstances were very different. The bank credit growth was already 6% plus, strong enough. There was no sign of deflation. There was already incipient inflation because they're restricting various supply issues for all the restrictions that were imposed on the economy. But that's when they adopted this policy. That was completely wrong. And the only intention could have been to create significant, that means double-digit inflation. There's no other way. And as I said, it's a very specific policy that is so rarely taken that we can't say, oh, this happened by chance or by accident. And it was also coordinated. All the central banks did the same thing. And therefore, again, you can't say, oh, just one central bank messed up and did it. It was clearly a coordinated policy. They wanted to create inflation. And therefore, this entire scenario is panning out. And by the way, it's very similar to the 1970s. I see no difference. Start with the official cover story. We're having inflation because of the war and the embargo and the energy shock. That's what they told us in the 70s, and people still believe the 70s was a sort of an oil price shock, a decade of inflation. It wasn't, because you can show quite clearly, as I do in my work, that the inflation started beforehand, even before that war, even before that OPEC oil embargo, and then the quadrupling of the oil price. That happened later. The inflation happened before. The timing is wrong and shows up same this time around. With the war.
It does. It does add to it. It does add to it. So I would say you have like the money creation that obviously if a bank gives money to consumers, it's a no-brainer. It's going to give inflation. But also, if Saudi Arabia right now stopped producing oil, that would obviously have an effect. So there is the both. And I'm sure that's quite obvious.
Well, if you look at bank credit creation in 1972, it was through the roof, and it was coordinated in all these countries.
That's the difference. But
that also happened again in 2020. So, in other words, these inflationary periods were created by central banks, and it looks like the same type of scenario is being rolled out. Now, there is a connection here to the monetary system. In the 70s, they used it in order to establish the petrodollar. So there is a good chance that they're currently doing the same thing to establish the successor of the petrodollar, because the petrodollar is in its last, last phase of life, let's put it that way. There are alternatives, and Saudi Arabia is now willing to sell oil against other currencies. And it's engaging with the BRICS countries, going to join the BRICS countries. And we now have the UN oil contracts in Shanghai, and Brazil also now preparing its companies for selling and exporting against Chinese currency. And so it looks like the American empire is working on the alternative, where they can't rely on the petrodollar support basis anymore. It has to be a new system. And it looks to me like it's based on coercion. As the sort of free support starts to voluntarily disappear, then they want to coerce. And the coercion is the control system called central bank digital currencies.
Boogeyman. Rich, we'll pursue it another time, because I could not disagree more vehemently with everything you just said there. This is not the 1970s. The 1970s, the petrodollar is a misnomer. Petrodollar really set light to the euro-dollar system. The euro-dollar system was a form of monetary creation which was not constrained by central banks, and it was not constrained by having to post your risk-weighted equity on your balance sheet. You could it was lending unlimited credit leverage, and it really was empowered by the petrodollar event, which came from a supply squeeze, a political supply squeeze from the OPEC cartel in the early 1970s. Inflation is a monetary phenomenon, and we had inflation in the 70s because these offshore banks that had this new kind of crack cocaine habit of profound leverage in lending offshore into all the banking domains of the world. They could not get enough. And therefore, what you saw was profound credit creation via loans to sovereigns and other large economic agents through the decade of the 1970s. And that financed the inflation in goods and services. All we saw in 2020 was a profound risk aversion moment where Procter & Gamble and large pharmaceutical companies and large AAA credit rating companies drew down credit facilities. They took any cash that was available, any short-term funding that was available from the banking sector, they drew it in, and it looked as if there was a profound surge in credit creation. It was the opposite. We have not seen a profound surge in risk appetite from the private sector to lend into this deflationary environment. And for me, I would contend that means that we will see the unwind of inflation quite dramatically. And sadly, we will see an accentuation in the pain of economic misery for the ordinary folk. Here I am in San Francisco. My goodness, it's zombie world out there. The China thing, the what do we call it? CBDC, the central bank digital currency. For me, again, I think you attribute too much intelligence to these bumbling kind of do-gooders. I don't think they have this kind of James Bond baddie thing to run the system. China et al. Need the generosity and the willingness of the US to accept all of this surplus international capital flow to come into the United States and to turn a once entrepreneurial society, the entrepreneurial society that built this amazing town of San Francisco. It reflects the industrial prosperity of 150 years ago. And today it's being replaced by, it's a carcass that's been laid bare as that society is turned into speculation, and it creates a 1% and then the many people, the destitute, which are left on the street and they're left behind. But all of that is for other times. I think
China has reduced its purchases and its exposure to US assets significantly because it has the Belt and Road Initiative, which is all about recycling the dollars by building infrastructure in countries that it needs to get raw materials from, and of course it continues to export. There's plenty of other countries to export to, so that's on this point. And we do have the inflation. I mean, it was created again just in the 70s. Same data telling us the same thing. The central banks did it. It happened in 2020. You must forget this lag, So it's ahead of the actual inflation by 18 months. And that's the source. So it is the same picture as the 70s. And I do think it points to the central bankers figuring we need to change the system as they did in the 70s when they created the petrodollar. I think it's a good name because you see, the fundamental problem was America had a huge trade deficit. You referred to it already then. It's now much bigger, but it was already a problem. And Japan and Germany had huge trade surpluses. And essentially, the Japanese and Germans didn't find enough American stuff they wanted to buy. And the Americans couldn't find what they could sell them until they came up with this idea, well, hang on, what does Japan need? What does Germany need? Oh, they need energy. They need oil. Okay. Let's go to Saudi Arabia. And they moved in with the American troops and they made this deal. We'll prop up the regime. You'll be an ally now. But you must only sell oil for US dollars. And then the whole commodities markets, is dollar denominated essentially. And anyone who challenged that, whether it's Saddam Hussein or Gaddafi starting to, offer oil against other currencies, there was severe reactions by the US against that. So all these Middle Eastern wars essentially driven by having to prop up the petrodollar. Russia has got an easier game. When Putin saw the ruble collapse initially after February 2022, he thought, okay, what the Americans did back in those petrodollar years, 72, 73, I could do that as well. And he announced, was it around April 22, he will only sell gas and oil against ruble. And I was interviewed on that day when the announcement was out and said, well, this is going to really boost the ruble because, of course, it's easier for Russia. It has the raw materials that it can export, and the ruble doubled within a few weeks. So that is how you prop up currencies, and the US has to come up with an alternative as the BRICS countries are increasingly switching away from the dollar. And of course, people like alternatives, whether it's Bitcoin or gold. Alternatives are increasingly found to be credible. So there is a need for something else. But that's maybe something we should discuss next time.
Indeed. We will continue with Josh's education. As we can all see, how does a young, curious mind like Josh, what chance does he have when you have these great minds like Richard and
I think you're too conflicting.
Oh, indeed. That's what I'm saying to you. Like, what chance do you have when you have you have a car. I don't know what I am. Okay, but whatever I am versus Richard's great wealth of wisdom and experience. And when we've fun, like what Richard says just drives me absolutely crazy sometimes. And you're a young guy and you've got to make sense of that. So Richard, I so hope we can do it again. I so hope you can drive me crazy and I can actually articulate myself better to show the respect that I have of your views, albeit views that I don't share. Maybe you can persuade me, maybe. But gentlemen, I want to thank you both for sharing your time with me. The asset capitalist community, I'm sure I speak on behalf of them all. We really appreciate it. You've given us much food for thought, for time for reflection. Here we are, gripped by the something which doesn't happen a lot. When we see large banks, sizable banks, the amount of assets and deposits that we're talking about is considerable, and we've seen them consigned to history as failures. The future will be intriguing. The future will keep us tuning in for the next episode. Josh, I wish you the best with your studies and your future career. And Richard, let's do it again. Thank you.